Good morning, traders. Today is July 17th, and I'm creating this special video update to highlight what I believe is a critical market event, which is likely to take place in the next 30 to 45 days, maybe a bit longer. We're seeing something I haven't seen in quite a while. Particularly, we're seeing retail traders jump into a buy the dip mode. This custom volume chart for the NYSE shows that we had the highest inflow of up volume shares on last week. Actually, this is a weekly chart, 20.10 compared to the bottom back here in 2018 on December 31st, which was a huge buy the bottom dip. And then everything else all the way through COVID this was the buy the bottom dip here in COVID. This was the continuous buying into stagnation through COVID. This was a buy the bottom here in 2021. And you can see we're just seeing a massive influx of buying the dip right now. Retail traders are pulling into the U.S. markets expecting the Fed to probably lower rates or pause and try to take a more dovish stance, where I believe we're seeing extreme credit risk. Let's take a look at something else here real quick. Well, let me stay here and move here. This is an example of what's happened over the last 50 plus years. So I need you to understand that here we have a ratio of how capital is functioning within the market. This is basically a derivative of M2. Here we have various GDP levels. We have Japan in blue. We have the S&P this is the SPX 500, the S&P 500 in purple. We have the Canadian World Bank in red, and we have the German GDP in green. And you can see that we had a big rally phase in Japan in the early to mid 80s, carrying over into the early 90s, before the Japanese GDP actually stagnated and their economy started contracting. Prior to that, it had primarily been the Japanese and the U.S. economy driving growth throughout the world, including Europe. And you can see here, Germany's GDP had continued to climb through the 70s and into the early 80s. You can see here in the late 80s, early 90s, Germany's GDP, the green line, continued to climb and then stalled after near the dot-com bubble burst. So what is unique here is to see the China GDP really ramp up here. And this is because they have been riding the backs of cheap global credit since the end of the 90s, since the early 2000s. And they have leveraged debt on top of debt on top of debt. There's multiple articles showing that China's middle class and upper class have all essentially leveraged profit on a bubble economy that's lasted more than 25 years. Essentially, the Chinese economy right now is probably leveraged somewhere around 140 to 150% debt to income level for most upper level Chinese citizens. Now that means that on a scale that is unprecedented, you're seeing a contraction in asset valuations and in the global economy, while a nation, including corporate and personal, is extremely in debt and rates are increasing. We could see this China become what Japan was in here the late 80s and the early 90s. This was essentially a bubble economy as Japan grew into a manufacturing powerhouse in the late 70s and early 80s, which actually started in the 60s and the 70s. It grew into a real powerhouse and then stagnated. China could be doing the same thing right now, this red line. And this shows us here again that money is not functioning like we had back in the 90s and back over here in the 70s. Remember, this was high inflation right now. This was high inflation in 82, 83, 85, 86. The U.S. inflation rate was through the roof. We had the Fed interest rates up around 15, 16%. We could see this moderate. Capital function could moderate back around this 20, 22, 19, 18 area, back down in this area, while this China contraction continues to unfold. Remember, this is from 2021. So this doesn't show us what's happening throughout the rest of 2021 and into early 2022. What it does show us is that the Federal Reserve and global central banks have printed a ton of money. They've dumped a ton of assets into the global markets through COVID and after COVID. We've seen this big speculative bubble. Primarily, if you look here, we've seen it happen only in China and the U.S. Now, the U.S. may stay a little immune from this a bit, but I'm thinking that the U.S. is going to see and going to feel some contraction. Okay? So it's coming. And what I want to try to point out here is this buy the dip scenario here could be extremely dangerous. We may have another 5 or 10 or 15 days of some upward movement, but boy, I'm telling you, there's something coming. There's something brewing out there that doesn't look very healthy. Even if the Fed were to move into a dovish stance, I don't see how this excessive debt to credit ratio can actually work itself out functionally without some sort of a deleveraging and revaluation event. Now, lastly, I want to point out this before we move on to other charts. This is, again, the same type of M2 ratio here. So you can see that we've peaked out, we started contracting again. Notice these areas of contraction in this area. This was the 2000 peak to 2003 bottom. This was the 2008-9 peak to the 2009 bottom. Okay, this was our pullbacks in 2018, 2018 here, 2009, end of 2018 here. This was our COVID peak here, and look at how aggressively we've pulled back here. We pulled back from 70-some% to 35%. We've actually seen a 50% pullback in capital function throughout the world and in the U.S. And if we have here, the blue line here is the dollar index, which is skyrocketing back over here. We have the purple line is the S&P 500 up here that is peaking. And then this is my global market index, the red line, showing you that the global markets, which includes China, Asia, Europe, and others, is contracting excessively, contracting far greater than the S&P 500. And a lot of that is due to what's happening with the dollar here getting stronger. Now, we have divergence between the dollar. We have a new high on the dollar. This is a monthly chart. If I remember right, yes, it's a monthly chart. We have divergence on the dollar. You can see it right here. If the dollar were to peak and start to contract, I want you to see what happens here. In late stage contraction, the dollar peaked and rolled over. In late stage, actually early stage contraction here, the dollar peaked and moved downward here and then started finding some support. This was the end of a broad cycle, you can see. This was the end of a cycle here. And we're kind of in this phase right here. If you look at this cycle phase, this was a cycle phase where the dollar was rallying, the markets peaked at the dot-com bubble burst, dot-com top, contracted, the dollar continued to rally higher through this expansion, credit expansion cycle, and then broke downward about 16, 18 months after the credit cycle had actually ended. We are now about 16, 18 months after the credit cycle ended, and you can see that the S&P 500 broke down, the world markets broke down excessively, the dollar continued to stay strong until the absolute bottom, just before the bottom was found. And I believe we're getting close to that point right here where the dollar will start to move downward. It'll be more of a global recessionary trend. And that's why I think the July 26th inflection point and cycle date, which is only 8 or 10 days away, could be very important. The end of July, early August could lead us into a massive contraction phase. Now, let me show you this with regards to gold and silver and the S&P and what to expect. Okay, so what we're going to see here is we're going to see the S&P 500 in blue. We're going to see silver in gray. and we're going to see gold here in the gold color. And now we're down at around 1700, which puts us down near these lows for gold. Silver is down below these lows slightly right over here. And you can see I created this chart on May 13th, 2022, about 2 months ago, predicting a contraction down to this lower level, which is a end of cycle phase before the cycle phase changes direction. And I think we've gotten there. I think we're at the capitulation low with gold and silver, and I think now fear is going to start kicking in. My opinion is the next 5 to 10 days, you're going to see fear grow as this upward trend, this buying into, come back here to show you, this buying mode that we see right here, these traders aggressively buying into this bottom is going to turn into an excessive amount of fear. When this bottom falls out, which will probably be around the 26th, 27th, 28th, or later of July, maybe into early August, you're going to see fear elevate excessively. And this is really kind of the chart that shows us where we're at. So we're at this point. We've seen the COVID lows take place. This was pre-COVID normal activity. COVID disrupted the global economic cycle. So at this point, year over year looks like strongly negative. If we go back year over year, it's going to look like minus 20, minus 25%, because the economic crisis of COVID really disrupted the global markets. Then as we recovered, even to this point or this point, you're starting to see some really big economic numbers, because year over year, from a minus 10% to a plus 5% shows 15%, where it may have only been at plus 2 or 3 or 4% normal activity. Well, this type of dampening sine wave is what we're going through right now. I feel we're in this area. We've reached a peak with regards to economic activity, but the economic data, which is the red line, lags about 3 to 6 months behind the actual current market economy. In reality, we're down in this area right here, and the economic data the Fed is going off of is still lagging way up here. By the time we get down to here with the global economy, the Fed is going to be looking at minor decline in economic data because it's all normalized going back over 12 months in most cases. And what we're really going to be looking at is an extended downturn for the next possible 16 to 12 months. Then we end up in a nice upcycle. So this is what we've got to be cautious of right now. We're probably right around this area in the downturn right now. And the next phase of the downturn with regard to economic cycle is going to bring us back into negatives from these excessive highs. It's going to bring us back into negatives. Then we're going to be looking at a short little, maybe 6 to 18 month rally, and then back into a 6 to 18 month contraction. Then we'll move back into normal type of price activity. So understand the risk factors right now, given what's going on in China and Asia, and I want to include Eurasia, which includes the areas, you know, east of Greece and Israel. All of those areas could end up in some very difficult economic scenario over the next 12 to 24 months as these cycle phases take place. The Fed, honest to God, is just not prepared for this. The Fed operates 6 to 12 months behind the market trend, and they are going to be tightening into an extremely collapsing market. Then they're going to be loosening into a rally phase, potentially then tightening into a contracting market, and eventually trying to ride this out. The best advice I have for Jerome Powell right now is keep rates moderate, nothing more than, say, 3.5% to 4%. And be prepared to adjust aggressively. My modeling systems say the Fed funds rate should be somewhere around 1.25% to 1.5% right now, maybe 2 on the high side. But the Fed is going to have to navigate these trends. The best thing they can do is keep rates moderate and let this cycle play out, deleveraging assets across the globe, which will provide for a very solid recovery phase, maybe at 2028, 2031, somewhere around there. But we have 6 or 7 years of this incredible cycle phase taking place, and it would have happened COVID or not, in my opinion, because the Fed would have raised rates no matter what through some sort of an inflationary trend and produce some sort of a bursting cycle. This just gave us a kind of an early disruption in the global cycle that we're playing out. So now, I want to point out a couple of things as we move forward here. This is the China Golden Dragon Global PGJ Invesco Exchange Traded Fund. This is weekly using my TT Charger software, and you can see we've broken out of these excessive highs. These are yearly, actually decade really highs. You come back as far as we can. We don't have any data, so let me get rid of that. And you can see we've come back up in 2008, 2009. This was the rally before the market crashed, and you can see we had a move from $40 roughly down to 11, 10, let's call it. That's basically a 75% decline. In this particular scenario, we've already seen from 84, roughly 85, let me try to get my lines here. We've already seen a 74, 75% decline, but off of these lows, we're now up close to 40%. We are looking for another decline back down into this area, potentially 40%, and many, many months and years potentially before China actually recovers from this excessive credit cycle. This excessive credit cycle and debt cycle, which is really a liability. Understand that this whole time frame, from this time frame here, they survived it because the valuation of assets throughout their economy hadn't really grown into an excess. This is a massive excess. This is a big liability issue where price valuation could drop 50, 60% from current levels before we wash this all out. And understand that from this level to get to new highs from this peak took almost till 2018-19. So it's a 10-year cycle. If this same thing happens from a hypothetical cycle, you're talking until 2031 to potentially recover for China. So we could see this play out as rotating, moving lower, and then somewhere around 2031 over here, potentially starting to move back to the upside. And this is probably a horrible example of a line. Well, let me try to do this a little better. Moving down, moving up, and then maybe starting to come back up out of it. That tells us that we have maybe till 2025, 2027 before we see some upward trend in the Asian Chinese markets. And understand, that's going to wipe out a lot of debt. That's going to cause a lot of trouble for this excessive. This is a bubble, ladies and gentlemen, just a massive bubble. So now let's take a look at consumer confidence, IYC, consumer discretionary spending in the U.S. This is the U.S. consumer discretionary sector, and we had seen back here in 2008, we had seen a move from 18 to 9, about a 50% contraction. A 50% contraction here from the $90 level would put us down here in the $43, $45 level, and we're not there yet. That would put us down here near these COVID lows. And what we're really looking for, ladies and gentlemen, is we're looking to get into these COVID low ranges. Okay, we need to potentially see this into this COVID low range or potentially below this 2018 high range. And this is where we need to see some sort of a capitulation base bottom. That would likely mean that U.S. assets continue to unwind for at least another 6 to 10 months into early 2022 before we start to see some sort of a recovery. Now, the next recovery phase, if I can show you, is going to probably look something like this. A standard excessive phase top is going to come down, stall, base, bottom, maybe attempt to get back up to these levels, maybe new highs, and that will be the end of wave 5. And that wave 5 peak will prompt a massive downward cycle that should take out these lows. So understand that the wave 5 peak will eliminate these lows with downward trending, and what that will probably look like is something more along the lines of an excessive down wave into this area from wherever the peak is. It's likely going to try to take out this low initially. So it'll come down below this low, stall, and then possibly move down into a wave C, D, and E, potentially lower. So this is where we're at. We're in this wave 4 correction. We haven't found a bottom yet. I think we need to get down into this area to find the bottom, and then we will potentially 6, 8, 10 months, maybe towards the end of this year, early 2023, start to move higher. And I'm expecting a big wave 5. It may just clear this level up here at some point in the U.S. market, but I'm expecting a pretty big wave 5 right now. Okay, so now next, let's take a look at transportations. Transportation has got the same type of setup. You can see that we've got this expanding wave. And you can see here, this is 2028-29, so, or 2008-2009, from 100 down to 36. So that's about a 70%, 65-70% decrease. 65-70% decrease puts us between here and here, roughly. So here we have the same type of scenario. Given this deep, deep low, we really want to watch these levels on the transportation index, the COVID low level. I'm trying to draw a horizontal line. There we go. And I will duplicate this. And we pretty much want that range. That is our target, ladies and gentlemen. So we need to be in this area, probably an IYT, before we're going to find some sort of a capitulation low bottom in the market, which is why this next phase, whatever is coming up with regard to China, Asia, and Europe, could be extremely dangerous. We are looking at, from where we're at right now, these traders buying into this phase, we are looking at another 20 to 30% down in the transportation index before we're likely going to find a bottom. Next, let's go ahead and take a look at the financial sector. Financial sector in 2008-2009 went from 31 to $5. Okay, that's a massive decline. That's probably 80-some%. Yep, 83, 84%. Will the U.S. banks see that type of decline? I'm not 100% sure we'll see that, because I don't believe the U.S. banks are as exposed to the risk right now. They are exposed to some risk, and I'm going to say that basically we're looking at these lows again, somewhere between here and possibly into these areas. And that would put us at the COVID lows, which we can see from way back here. Presents a very solid base. And then if I duplicate it and drag it to this early 2017 peak, this is the area that I was looking at right here, which is what I call the midpoint of the COVID lows to get us where we need to go. And this would be an unwinding of the U.S. cycle to present a very solid bottoming formation for the next wave higher. Lastly, I want to point out the, I think we've done it, but let's take a look at DBC, the U.S. commodity cycle. There's been speculation that the U.S. commodity cycle could rally higher from where we're at right now, but I don't believe we're going to see much of a rally at this point. Remember, as I was mentioning to you and showing you here, we are now down in this cycle phase. This is a destruction of demand and consumer cycle phase because of what's taking place throughout the world with excessive capital in the markets. So we are now in this destruction phase where we need to watch for downward lack of demand going forward with regards to consumers. And that means that we are going to likely see some sort of a decline similar to what we saw over here in this destructive phase, but it's probably going to originate in China and Asia, possibly over into Europe. So a 60% decline would be back down into this area. Wow, all the way back down to the COVID lows again. And that doesn't seem undoable, although I would suggest that these 2017-18 ranges back over here provide a very solid range. So I would say something across here. And I'm not trying to be a doomsayer by any way, shape, or form. I am just trying to warn you that there is very limited opportunity for an upside bounce right now in this market, given the fact that Chinese consumers are extremely strained with COVID and lack of economic function and lack of jobs. They are 130 to 150% debt to income ratio. Same thing with corporations. It's extremely fragile right now in most of Asia, particularly in China, and I am imagining that's carrying over to other nations in Africa and Eurasia, whereas Europe and the US, Canada may be totally different. I'm seeing that this bubble in Asia is going to burst, and I think we're going to see it fall out. Now, let me show you something that I thought was very, very interesting. It's right here. So this was the website that I found, Asian Development Blog, ADB, blogs.adb.org, and this is Private Debt, Hidden Menace to Asia's Financial Stability. The date on this is unknown, but it carries forward to 2017 with the data, and I just want you to highlight this. From 2008 to 2017, household debt in selected Asian economies. In the Republic of Korea, the debt has shot up more than 30%. In Thailand, from 2008 to 2017, roughly 9 years, the debt has shot up more than 40%. In Hong Kong, China, the debt had shot up from 51 to 70. That's 20, so that'd be about 35%. In Singapore, the debt had gone from 42 to 58, roughly 60, 18 points, so that's about 50%. People's Republic of China, ready for this, guys? The debt had gone from 17.6 or 0.8 to 49.2. That is 100, if I do the math right, 140% increase in household debt prior to 2017. Now remember, this was when everybody was chasing the housing market rally and cheap U.S. money was available. This is incredible. This is a huge liability to individuals and corporations and pretty much every sector of the Chinese economy. In Indonesia, it only went from 11 to 17, which is still a 50% increase. And in India, it went from 10 to 10, 0.1, 0.7, so it went up about 10%. Now, in the second image here, non-financial corporate debt in selected Asian countries. In Hong Kong, it went up from 129, 130 to 230. Wow. Okay, that's an 80% increase in Hong Kong between 2008 and 2017. The People's Republic of China, it went from 87 to 157. It's not too, it doesn't take too much of a brain count to figure out that that's nearly 100% increase in total non-financial corporate debt. In Singapore, it went from 87 to 106. That's approximately 16-17% increase. Republic of Korea, it actually decreased. Thailand, it went from 43 to 52. That's about a 10% increase on 43. That's 20%. If I do the math, in India, it went from 43 to 46. That's about a 10% increase. And in Indonesia, it went from 15 to 23. That would be about a 45% increase. So really what I want you to focus on here is Hong Kong and China have, which is really China, have increased their leverage by almost 140% between 2008 and 2017. What do you think it is over the last 2017, 18, 19, 20, 21, and now 22? I'll bet you we're looking at possibly a 250 to maybe 350% increase in debt in China and in some of these areas as the housing market just continued to expand and credit markets continued to expand over the last 5 years, which is why I'm telling you, this deleveraging event in Asia and Eurasia could be extremely dangerous. You're talking about something that's gone up 300, maybe 400% over the last 15 years. And now you're talking about extreme contraction with individuals that are, let me find this right here. Household debt as a percentage of gross domestic product stood at 62% at the end of the second quarter, down 0.1 percentage points from its historic peak of 62.2% at the end of last year. Let me check the date on this. This is August 2021, so about a year ago. And this is from the China Macroeconomy website. It's scmp.com. I love reading this stuff. This is sources that we do not get. End of last year, China's household debt as a percentage of disposable income had reached 131% roughly. Service loan payments is eating up disposable income that would otherwise be used to buy goods and services to support the economy. What's really critical to understand is, and I loved reading this, where is it? Debts have hugely reduced our family's quality of life, said the housewife in her 40s. Except for tuition fees for our children's international school, I'm trying my best to reduce our living expenses to within 5,000 won per month. That's very, very cheap, actually. I think that could convert to about $500 US or about $440 US per month. The properties are appreciating. Again, this was end of last or August of last year. The properties are appreciating, but I feel we are walking a tightrope in midair, and I worry every day that we won't have enough money to repay the mortgages. The family's predicament is indicative of the growing levels of household debt in China, which threaten to undermine a resurgence in consumer spending and that the government hopes will propel the economy through the second half of the year. Debt is rising swiftly, blah, blah, blah. And then, of course, they highlight the small to medium-sized companies and the non-bank lending services in China, which have been used to fill short-term loans for people who need it. But's really getting interesting is, like I said right here, is, however, by the end of last year, household debt as a percentage of disposable income had reached a record high of 131%. This was at the end of 2020, because the article was written in 2021. I'm imagining by the end of 2021, with the huge recovery taking place in the economy, household debt had shot up to about 140, 150%, maybe more in China compared to income. And now with the resurgence of COVID and the tightening economy, I can understand why China is at great risk for having a massive contraction phase taking place. So I'm going to leave you with this chart right here. PGJ, the Invesco Exchange Traded Fund, and I want you to pay attention to what actually took place here and what could take place in China and Asia over the next 6 or 7 years. We may see an extended decline. We may see some very big trends taking place, which is why I urge you to follow my research. Join me on Twitter. Follow me on YouTube, because there's going to be some great opportunity for traders, swing traders, using my tools and using my resources. But right now, I'm waiting for that next contagion event, and I think it's coming from China. I think China is going to be the next big bubble to burst. Either that, or it's going to come from somewhere near China, and it's going to then translate into China and other areas, potentially Eurasia, and really start to unwind, presenting a really big 3 to 5 year downward deflationary cycle. All right, there's your warning. Follow me, visit Mint.com, and remember, I'm giving you my information and my opinions only. I'm not telling you what to do or what to trade. I want you to make those decisions on your own. I'm just using my tools and my research and my skills to help you understand what's coming. So this is a warning in advance of what I see is a crisis event which could take place over the next 20 to 30 days, in my opinion, and could be a real sudden event. All right, that's it.